BofA Securities head of U.S. equity strategy, Savita Subramanian's here. S&P target of 5,400. It's great to have you, Savita. Welcome back.
Great to be here. Thanks, Carl.
Your notes have been like an endorphin drip last couple of months because you've talked about broadening.
Yes.
No euphoria yet.
Right.
Does the gut check this week change any of that?
No, I still think that we're on track for gains throughout the end of the year. I mean, obviously, we're just a few percentage points away from our year-end target, which we just recently raised. But I think the net message of all of the data and the signals and the analysts and everything that we look at and listen to is up rather than down for the S&P. And the idea here is, I mean, when I look at positioning, I don't see euphoria. I see kind of cautious optimism, maybe on a few themes like AI or, GLP-1s or, now it's shifted to power. But I don't necessarily see this broad-based bullishness on the market. In fact, if you look at the average mutual fund, the average active manager, their beta relative to the market is the lowest we've seen since 2008. If everyone was looking for a bull market, they would be long high beta stocks. And they're not. So I think we're still in that kind of wall of worry phase. I would still say the direction's up from here. You
recently went to 250 on earnings for this year.
We did.
And next year
We're looking for like about a 10% incline on earnings next year. And the idea is we're tracking solid earnings growth. We've had margins remain surprisingly flat, not down as everybody was expecting. And I think that means that operating leverage you could get from a demand recovery is going to be that much healthier. So we increased our earnings forecast primarily on just the health of corporate margins. And I think it's kind of nice to see that corporate America has been able to navigate 9% inflation, then, 4%. I mean, this has been a wild roller coaster of CPI prints, but margins have been shockingly stable.
We heard from Stevie Cohen just a moment ago, but something else that he shared was his idea that, in fact, the productivity improvements, and I think I'm getting this right here, I don't want to put words in his mouth, from AI have not been fully appreciated by the market. I'm curious as to how they figure into your earnings estimates and or your overall theme.
Yeah, I think that we're at a point where, we're seeing companies do the right thing. They're spending on automation. They're spending on efficiency, which is what they typically do when you start to see signs of labor inflation. So a couple of years ago, right after COVID, you started to see these automation companies like, industrials, now AI, really reap that CapEx. They were the CapEx takers. I think at some point you're going to want to stop owning the CapEx takers, like the chip companies, and you want to own the companies that are buying the stuff to do things better. And where we are in that trajectory, we might be early in some industries and later in others, but we've already seen a marked shifts in the job market and skill sets. I mean, think about Python programming. That used to be like the number one thing that everybody looked for on a tech person's resume. Now you don't need a Python programmer because, you have AI to program for you. So I think these things are happening real time. In certain industries, it's going to be slower. In other industries, it's already happened.
Are you not afraid, Savita, of rising Treasury yields and a stronger dollar, which is really starting to manifest itself?
Yeah, no, I am. I think that's the risk, is that where I see upside risk in rates is really on the long end. The short end, I think 5% is manageable. Even if we had no cuts this year, I think it'll be okay for the S&P. But on the long end, I mean, if you think about it, the sources of demand for treasuries are gone. I mean, it used to be like, who was buying treasuries? The Fed, China, Japan. None of them are buying anymore. So I think that just that demand vacuum is part of the problem. But there's also the growth angle, which I think is, maybe underappreciated. And the reason that the long end could move higher is because of better nominal growth expectations, better long-term growth expectations. And I think that's starting to percolate with your average investor. The idea of a positive growth surprise, which wasn't on the table last year, is now becoming part of the conversation.